Normally, and what you hear everybody say is the unemployment rate is rising because people are losing their jobs. But that's not the case now. What you're seeing is while the unemployment rate is going up, job growth continues to be positive. So, where is this unemployment rate coming from? And this is where it gets really political and somewhat toxic. Jay Powell said in his September 18th meeting, it's coming from an increase of labor supply, mainly from migrants coming over the border who are unemployed. Depending on the measure you use, it's between 7 and 15 million people more in the country. So it's like we added another state of Georgia without realizing that we've done it. And that's how you wind up getting inflation.
Very pleased to welcome to Monetary Matters for the first time, Jim Bianco of Bianco Research and Bianco Advisors. Jim, great to see you. What are you thinking about in markets? What are you paying attention to and why?
Hey, Jack, good to see you too. And congratulations on the new show. I think the first thing we have to start thinking about is the big change in the last month was the Fed cut rates. The Fed cut rates by 50 basis points, which until the Nick Timiraos story came out a couple of days before the meeting was not expected. And the reaction in the broader markets to that 50 basis point cut, and specifically I'm talking about interest rates. Whether you're talking about the 2-year out to the 10-year, interest rates went up. But they've gone up by more than what we've ever seen in the last 35 years of initial Fed rate cuts. The 10-year note yield is up by about 48 basis points in the roughly 19 or 20 trading days following the Fed rate cut. We've never seen it happen. Most of the time, rates are either flat or fall when the Fed starts to cut rates. And so really, one, why are rates reacting so badly to this rate rise? I mean, it's funny because everybody says the Fed's going to cut rates. What does that mean for your mortgage? And no one has said it's going to go up, because that's what is exactly happened, because market-based rates, which is what like mortgages are set by, borrowing rates are set by, have gone up in yield. So why has that happened? And I think that the short answer is, to some extent, the market is rejecting the 50 basis point cut. It's saying to the Fed, you move too fast. Your intentions are to continue to move too fast. And we fear that you're going to overstimulate the economy and probably reignite inflation. And that's why you've seen such a bad reaction out of the bond market to this oversized rate cut to start this move.
The stock market obviously loves the interest rate cut. The bond market does not love it. So after the 50 basis point cut, the 10-year went up, you said 48 basis points. Mortgage rates have gone up, which is a 30-year rate, although the duration is shorter. How common is that for the Fed Reserve to cut the short-term overnight rate, Fed funds, and all the according, very short-time rates, so for repo rate, yada, 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 and then for the 10-year to go up? And for people who are wondering why that's happened, it's because the Federal Reserve cuts that are priced into the market in the old 10-year have been priced out.
Yeah, that's correct. A couple of things to keep in mind. Let's just make sure we understand what we're talking about. When the Fed cuts interest rates, it really only has heavy influence over very short-term interest rates. Fed funds rate, which is the overnight rate that banks borrow to and from each other, say, overnight repo rates, short-term treasury bill rates, money market fund rates, SOFR, which is secured overnight financing rate, which is another rate that banks borrow from each other as opposed to borrowing from the Fed. These are very short-term instruments with maturities of either 1 day to, a month or so. Those rates are down. Those rates are down because they're heavily influenced by the Fed. Now, when you start getting out further out to a 2-year note, a 3-year note, a 5-year note, a 10-year note, or a 30-year note, those rates are more market dictated. Those rates are up. Now, it's not unusual for rates to, trend sideways to up a little bit after the first rate cut, but not to the degree that we've seen. That these rate rises that we've seen since the Fed started cutting rates are up a lot more than we've ever seen. And like I said, in the last 35 years or so, that the Fed has been cutting rates. Whenever they initially started, I'm not picking every rate cut, I'm saying the first rate cut, that we've seen this, because the first rate cut is supposed to signal a campaign of lots of rate cuts to follow, much lower interest rates into the future. And that's not happening. Now, part of that is, you could argue, this has been the most telegraphed first rate cut ever. The market has priced in the entire rate cutting cycle. So if you go back to April, in April, the 10-year note was at 475. The day before the Fed cut rates, it got down to 360. So that was 115 basis point or 1.15% decline in rates from April to the day before the Fed cut in September. The whole move was priced in. That's it. It is done at that point. And that's why you might be seeing the market, one, not falling in rates anymore following the first rate cut. And two, because the Fed decided to go 50 as opposed to 25, let me remind you, a week before that meeting on September 18th, the market was pricing in the Fed's going to cut 25. Then Nick Timiraos wrote a story suggesting that the Fed was going to cut 50, and bam, everything changed in 24 hours, and it priced in a 50 basis point cut. And we got a 50 basis point cut. And then we got the FOMC minutes the week before we're recording for that September 18th meeting. And it showed that there was not agreement at all at the Fed about what they're supposed to. They all vote with each other because that's kind of what they do. But there was not agreement at all as to what the Fed should do, 25 or 50. And it seemed like Powell forced through that 50 basis point move, reasons unknown at this point. But the market seems to be rejecting that move. It was rejecting it going after that move in through the stronger than expected payroll. And again, I think what the market is rejecting, I'm talking about the bond market right now, we'll get the stock market in a second, is that you moved too fast, and you're telegraphing a lot more faster moves, and that's too much, and that the bond market is worried about inflation, that you're going to overstimulate the economy, create inflation, and therefore I don't want to own 10-year notes. And that's why you've seen that sell off in the 10-year note or the rise in yields.
So the Federal Reserve has a dual mandate for low stable inflation, its target of 2% inflation, and full employment. Over the past 2 years, since inflation, past 3 years, since inflation has been very high, the Federal Reserve has been focusing on low inflation, get inflation lower, and unemployment has not been an issue. It's been very low. Now the Federal Reserve is saying that it is focused on both sides of its mandates. It sees risks to the upside to the inflation, but it also sees risk to the downside for a recession, for the labor market to exacerbate and get a lot worse. Are you saying, Jim, that you think that is a wrong course, and that the main risk now to the economy and to markets is still inflation and not recession?
I've always thought, first of all, to the last part of your question, I've always thought that inflation has been the bigger concern. I think the cycle changed in 2020. And I think what you hear a lot of economists, including Jay Powell, uses words all the time like we're returning to normal, returning to a pre-pandemic level. The economy's broadly normalizing. He uses these words all the time. And I've argued, what's abnormal about this economy? What he's arguing is we're going back to a previous cycle, that the cycle ended. The 40-year bull market in bonds ended in 2020. The cycle of low stable inflation ended in 2020. The very nature of the labor market because of remote work ended in 2020, and that we're in a different cycle right now, and quit pining for a return to the 2010s. That era is over right now. So I've always been worried about inflation. On the unemployment side, there's a giant debate, and it's getting muddled with the election. The unemployment rate was 3.5 a year ago, hit 4.3 a couple of months ago, and it's down to 4.1. So that's a rise of 0.8%, now net 0.6% over a year. That's a fairly significant rise taken in a vacuum. Normally, and what you hear everybody say is the unemployment rate is rising because people are losing their jobs. Now, normally, when you see a 6 or 0.8% rise in unemployment rate, that's the case. But that's not the case now. What you're seeing is while the unemployment rate is going up, job growth continues to be positive. So where is this unemployment rate coming from? And this is where it gets really political and somewhat toxic. Jay Powell said in his September 18th meeting, we know that the increase is coming from an increase of labor supply, mainly from migrants coming over the border who are unemployed. He said it. So we know what's happening, right? We know that every day migrants are, over the last 4 years, people have been entering this country and they've not been employed, and they're getting picked up in the surveys, and that's causing the rise of unemployment. That is extraordinarily toxic to say, because it cuts down the political spike between what the Democrats feel about immigration and what the Republicans feel about immigration, and that's why it's been such a difficult thing to argue. But it's largely been the case. You could actually see it in the Congressional Budget Office data, where they have pointed out that the growth rate, the population growth rate of the country, is the highest it's been in 30 years. And that's not because there's a baby boom. People are not getting married and having kids. It's because we've got this flood of migrants into the country. Cumulatively, depending on the measure you use, it's between 7 and 15 million people more in the country now than there was in 2020. Just to give you an idea, the state of Georgia has 11 million people. So it's like we added another state of Georgia without realizing that we've done it. Now, I'm not going to make any moral judgment about whether they should or should not be here. I'm saying they are here. And I'm saying that they are here, and they are here in higher proportions of unemployed than the domestic population. And that's why the unemployment rate is going up. So the question then becomes, well, what are we going to do about this rising unemployment rate? Well, first of all, it's not happening because people are losing their jobs. It's happening because we have more unemployed people in the country. The second thing is, okay, so what do we do about that? Do we cut 50 basis points? Do we stimulate to try and create more jobs for these unemployed people? Fine. Then we do that. The reaction that you could get by stimulating to try and create more unemployed people to get jobs is more inflation. And that's where I think the bond market is having a problem with it. The problem is, Jack, the day we're recording, we are 24 days from the election. In 25 days, we can have this discussion. But in the next 24 days, we're not allowed to have this discussion because it cuts down such a political line, and we're such a polarized country.
Jim, I feel the same reluctance as you to address these topics. This is a market show, and I have a rough sense that half my audience is on one side, half is on the other. But so immigrants coming into the United States, is it really true that they have a higher unemployment rate? Don't immigrants typically work a lot compared to Americans? And also, is it possible that they have jobs and they're contributing to the economy, but it's just not documented because they are not documented?
That's exactly right. That's exactly right. Now, keep in mind, the unemployment rate is 4.1%. Let's call it 4%. So when an immigrant comes into the country, unless 96% of them are employed, I'm not saying zero are employed. I'm just saying that if 96% of them are employed, then the unemployment rate doesn't change. If 90% or 80% or 70% of them are employed, then they are bringing in an unemployment rate of 10, 20, or 30%. And that would push up the overall country's unemployment rate. As far as what you're saying about them being employed, that is true, that they're employed. Keep in mind one thing about getting a job in the United States. In order to get a job in the United States and have a withholding, you need one of two things. You either need a Social Security number, which you get when you're born if you're a citizen of the United States, or you need a work permit. And then your work permit assigns you a number so that the IRS has a facility so that your employer can withhold taxes from you. About the estimates these are only estimates and surveys, but about 80% of migrants that have come in the country, obviously they don't have a Social Security number because they weren't born here, but about 80% of them have not applied for a work permit, but they still have jobs. They're getting paid under the table is what they're doing. So let me turn you to a statistic that came out last month when the benchmark revision of the payroll came in and it fell by 818,000. They do that measure by looking at they look at tax returns, and they look at the number of people that are getting unemployment insurance and the number of people that are paying into the unemployment insurance fund. And they concluded that 818,000 people are paying taxes related to unemployment insurance or receiving it than we thought. And that got spun. The narrative was the economy created 818,000 less jobs. I think Goldman Sachs had it right, and I've been parroting Goldman Sachs, that their estimates are more like the economy created 300,000 less jobs. The other 500,000 were people getting paid under the table, meaning that they're not getting withholding. And that, why is that important? Because those people are getting a paycheck, presumably every week. They're generating income, they're spending that income. So the week we're recording, we're going to get the retail sales numbers. The other thing that's been happening with this economy is, even though the unemployment rate has been going up, it's been diverging from retail sales and consumption. Because if people are not, the biggest reason you spend money is you have a job. Well, if people are not, getting jobs, if people are not seeing that income, they're not going to spend as much. But yet the retail sales and the consumption numbers are very strong, and they continually beat Wall Street's estimate. Why is it that they're so strong? Because maybe there's a lot more employed people than we think. They're just being employed under the table. So this is why I think that this is important, that there's a lot more jobs in the country. So if you're saying, no, we've got this unemployment rate, we need to lower rates, stimulate the economy to create even more jobs on top of that, that's great. No one doesn't want somebody to get a job, but there is a consequence to doing that, and that consequence is inflation. And I think that's what you're seeing out of the bond market right now, is that concern that the unemployment rate is really more of a measure of the population change in the country, and not that people are losing their jobs. Even if you look at the JOLTS report, the job opening labor turnover report, they have a section in there called job separations, how many people have been fired or laid off. That's at some of the lowest numbers in 20 years. So people aren't getting laid off. And so what we're seeing here is a belief that the economy is slowing when it may not be, and we might be trying to stimulate the economy when it may not need it, and the result could be inflation, and that's what the bond market's sniffing out.
And so if there are a lot of immigrants who are working who are not being captured, that means that the Federal Reserve could react to a rising unemployment rate when it really isn't labor weakness, and they could overstimulate. You call it inflation, but I just say stimulate the entire economy. So they're stimulating nominal growth, but also corporate profits and the stock market. So maybe there's a risk that the stock market could overheat. Maybe that's what we've been seeing, as I believe the stock market's had the best year-to-date performance since 1997 or 1998. Jim, but you referenced JOLTS. The labor market has been weakening. It's just been weakening from a ridiculously hot level, and you're saying it's less weak than a lot of people think. I mean, the JOLTS, the number of job openings, is well below its peak in 2022, and it is below trend. So you do acknowledge that there has been some, as Powell says, softening in the labor market.
Oh yeah, there's been some softening, but a couple of things about the current level of the labor market. The JOLTS report also, for those of a certain age, it used to be the old newspaper wanted ads, but nobody does that anymore. So that we created the JOLTS report in 2000, job opening labor turnover, how many jobs are being advertised in the United States, and they do it via a survey. And it's about 8 million jobs right now. People are looking for workers, and there's about 6.5 million unemployed people. So the number of open jobs to the number of unemployed people is above 1. Now, bear in mind, not every person who's unemployed is qualified for every one of those 8 million jobs. Either they don't have the experience or the educational attainment, or maybe they just don't live in the right area to get those jobs. But that ratio above 1, never saw that before 2020. And while that ratio was close to 2 about 2 years ago, and it's come down to 1, and we call that softening, this is far and away higher than anything we saw prior to 2020 in terms of that number of open jobs. Now, also keep in mind, too, the nature of work has changed as well, or the nature of work has changed. And I'm going to give you a statistic on this. The ADP, the Automatic Data Processing report that comes out 2 days before the payroll report, has a unique series in it. Just so we all know, ADP processes about 20 million payrolls a month. They're the largest payroll processor of about 160 million people that have jobs. So ADP uses their vast network of jobs that they process to put out some statistics about the economy. They're saying that since 2020, since the recovery began after the COVID lockdowns, 42% of everybody who's gotten a job has gotten a job at at a company of less than 50 employees. And 25% of them have gotten a job of less than 20 employees. Jack, you're 20 less than 20 employees. We're less than 20 employees as well, too. So why is that important? Because when it comes back to that migrants getting jobs under the table, Target or Walmart or Chipotle or McDonald's, they're not going to hire migrants under the table. Might they be cheaper? Sure. But if the Labor Department catches them doing it, the fine for a big corporation like a Walmart far exceeds whatever monetary benefit you would have by underpaying an under the table migrant. But if you're working for a company of 10 employees or 15 employees or something, the odds that you're ever going to get audited in the first place are very, very low. And they're taking that risk by hiring those migrants as well. So the point is that everything points to a labor market that I think is stronger than we think it is. And if we're going to stimulate and create even more jobs, think of it, in the metaphor of people running to the store with handfuls of cash because they just got paid to buy things. And what we're finding with retail sales and we're finding with everything else is that, well, if they're going to start running to the store in greater amounts with cash because they're getting more jobs, we're going to have to start raising our prices because the demand for our stuff is going to go up. And that's inflation. And that's how you wind up getting inflation. If you misjudged the number of jobs in the country to begin with, and then try to stimulate to add more jobs, and look, no one is against jobs. It's just, what is the cost of overstimulating for those extra jobs? It's higher prices and it's inflation. And that's the balance that we have to put against. I'll come back. Powell acknowledged this in his presser on September 18th. We know that the increase of labor supply is coming from migrants that are coming in higher unemployed proportions, meaning they're not 100% unemployed. They're just 90, not 96% employed. He acknowledged that, but then dropped it, cut 50, and started worrying about the labor market being very weak. And then we've seen what the bond market reaction has been.
So, Jim, how do you explain the remarkable disinflation that has happened? Disinflation, of course, for our audience, is the rate of inflation going down. Prices only go down when that's deflation, and that sounds like a good thing, but most of the time it's not. Inflation peaked at close to 9% in 2022. It has since dropped like a rock, and so now one measure of inflation on a 12-month basis is 3.3%. Another measure on a 12-month basis is 2.2%. That's PCE. On a 6-month basis, PCE is 1.9%, below the Federal Reserve's target. On a 3-month basis, PCE is 1.5%. Core PCE is slightly higher, so that indicating, I think, the price of oil has gone down, and that has helped things a lot. But I mean, this thing where the labor market softens, but it doesn't collapse, and inflation falls sharply, that is a Goldilocks scenario, and that is why the stock market has rallied, not just from the beginning of this year, but since October, over the past 2 years. Do you think inflation has bottomed? And also, what do you make of these 3 months, 6 months annualized measures of inflation that indicate that inflation is actually even lower, and in some cases, even lower than the 12-month figures, and in some cases, even lower than the Fed's target?
So let me use CPI as my metric here. You're right. We hit in June of 22, 9% on year-over-year CPI. And the transitory crowd was right that a lot of that was partially due to the supply chain constraints that pushed up prices following the reopening of the economy in 2020 and 2021. And then that number has come down quite a bit. It's come down from 9% to about 2.3 on CPI and about 3.3 if you take out food and energy. Now, a couple of things about that number. I'll stick with CPI for an example. When I say that I'm worried about inflation, the Fed has a target. Let me frame this, why this matters, because a lot of people that don't work in the bond market think these are all rounding error numbers, but they're really not. The Fed's target for inflation is 2% and get it under 2% or around 2%. I think that the inflation rate is going to stay at around 3%, say between 3 and 4%. Okay, isn't that close enough to 2? Not if you're worried about interest rates, because if the inflation rate goes under 2%, you could make the case that the 10-year treasury's proper yield then is around 3 to 3.5. If it's going to stay between 3 and 4%, you could make the case that the 10-year treasury should be between 4.5 and 5. And ask anybody in the stock market, well, if I move the 10-year treasury to 4.5 to 5 next trade, what do you think the stock market would do? It wouldn't like it at all. It would have a big problem with it. And if you move the 10-year treasury down to 3%, it would love it. So that's why that 3% or so versus 2 matters. Now, why do I think it's going to stay at 3? Well, first of all, on the headline inflation at 2.3, part of that, a big part of that, because remember, it's 1% below that 3.3 or so that you have with core inflation. So first of all, you had a $25 drop in oil prices, which has impacted gasoline prices accordingly. And that's been a big drop. And so that has depressed the headline CPI, which includes gasoline, which is around 6% or so of overall CPI. The core measure, when you take out food and energy, is still above 3. It bottomed about 4 or 5 months ago. It's not showing many signs of declining anymore. And there's a big residual seasonality in inflation. What do I mean by residual seasonality? If you look at the seasonal adjustments in inflation, it's U-shaped. It's in the June and July, it subtracts from the not seasonally adjusted number to help depress it. And then in the end of the year, when you get to October, November, December, and into January, it adds to it. And usually, if a seasonality is done correctly, it shouldn't matter. But this one does. That's hence the word residual seasonality. That during the year-over-year change in CPI does take on a U shape, just like the seasonality takes on a U shape. Well, we're now in October, and we're now in the period where that seasonality will start pushing those numbers higher and keeping that core number above 3% using year-over-year CPI, just as one number as well. And I think what we're going to find is, yes, we had a transitory thing. Yes, that transitory thing went away. And when all the dust is settled, we are at a higher inflation rate than we've been before. Now, why are we at a higher inflation rate? When we talk about CPI, and I did it myself in the previous question, we assume goods, right? We go to the store, we buy things. We buy groceries. We buy gasoline. Stuff, as my friend Dennis Gartman liked to say, things you could drop on your toe, only account for about 25% of CPI. The other 75% is services. So what is the vast majority of what we spend our money on? Somebody doing something for us, services. What has been very elevated in the inflation numbers has been services. If you look at that 3.3% CPI number, if you look at food, energy, and goods, collectively, they're at about 0 on year-over-year change in inflation. Services is about 3.3, and that's really all of the inflation. That services is what we see is in a change in the labor market, and that we've seen employees realizing, witness the port strike from a couple of weeks ago being the last example of it, getting a 62% wage increase over 5 years. 62%. Canadian pilots at Air Canada just rejected a 42% increase in wages over 5 years. What we've learned is, prior to the pandemic, the mentality was, shut up, be lucky you have a job, don't complain. Today, the mentality is, hey, Mr. Boss, I want a raise and I want a day at home. I want remote work. And if you don't give it to me, I am quitting and I will quit. And bosses say, please, don't quit. Here's more money. Here's a day at home. And so what we're doing is we're finding that from a services standpoint, wages are staying much stronger because of the way that the market has changed, and that we're finding that employees have more power than employers. And that's what's going to keep the inflation rate up. Powell invented a statistic for this called core services. Supercore, which is core services X housing. What is that measure supposed to be? That is his way of saying, let's look at all of the inflation measures that are impacted by wages. That number's still over 4% and heading back up. So, yeah, if you're going to look at the price of stuff, it's not going up. But 75% of what you spend your money on is services. And what drives a service price is how much you have to pay the person to do those services. And wages are up, and wages are what's going to keep this inflation rate high. And with the Fed cutting rates stimulating things, again, I keep coming full back to, I'm trying to explain this unusual anomaly in the bond market that the Fed cut rates and all interest rates went up, when everybody keeps telling me, what does it mean? It's good for your mortgage. It's good for the economy. Interest rates are supposed to fall. And that's not what they've been doing since the Fed cut rates.
Right. And wages from the Atlanta Fed are up about 4.7% year over year for September 2024, well in excess, actually double what headline CPI is at 2.2 or 2.3%. So that's a good thing. Jim, I don't like to push my guests too hard,
No,
but
you
I know
push
you
all
can
you
handle
want,
it.
man.
The quits rate has gone down a lot from 2.9%, super high, or actually, sorry, 3% in 2022 to now 1.9%, which is below 2017 to 2019 levels. So people are quitting their jobs less than they used to, right?
Right. So keep in mind two things. First of all, on that Atlanta Fed wage number 4.7%, the unit labor cost number is around 4% or so. What it means is that the average wage raise, your average raise in the country is around 4% is, or it has a four handle on it. Now, over long periods of time, wage growth and inflation have to kind of be close to each other. You can't have prices keep going up 2% a year and everybody keep getting everybody on average getting a 4% wage increase, because you will have 2% more money in your pocket at the end of the year, and you will use that money to buy other things and start bidding on those prices, even if it is a service, and you will start pushing up those prices. So wages and they don't have to be exactly the same, but a 2% gap is huge. Usually they're differ by about 0.5% or so. So if wages stay in this 4-ish% range, they will continue to have upward pull on the inflation rate. Now, on the quits rate, the thing about the jobs market you have to keep in mind is when we look at, let's say, the payroll report for September, and it was 254,000 jobs added. That's net jobs added, right? That's the total number of people that quit jobs versus got jobs. 254,000 more new jobs were created than quit. But how many people are actually churning a job in a week? Now, in a typical week, you will have about 1 million people either leave a job or get a new job. So that means that on average, it take about 3.25 years for everybody to turn over at least once. And so the quits rate measures the velocity of people turning over those jobs, right? How many people are quitting jobs? Well, we measure quits because what do 95% of people quit a job for? Another job. That's why they quit. I quit this job because I took another job for whatever reason. Either it was more money or geographically better or something along those lines. The churn in the labor market is slowing. That's what the quits rate is telling us, is that the churn is slowing. I think people misunderstand what that churn means. The churn means that people are more satisfied with the current job that they have than willing to look for another job. Now, maybe it's because wages are increasing at 4% and that they don't feel like they're being underpaid and they have to get another job. Or maybe it's because after 4 years of demanding remote work and all of these other things, they've gotten what they've want and they're a little bit more satisfied. Maybe it's after 4 years of turmoil in the labor market. What does it mean to have a job post-pandemic? And yeah, it does mean something different than it meant in 2019. We're starting to understand what that means, and we're starting to feel that out. And so the number of people churning their jobs as much is not as great. So you're right that the quits rates come down, but I think that that's largely a misunderstood number. It's just about the churn in the labor force. It's not necessarily about job creation or job removal.
Thanks. So you're bearish on bonds. You think long-term interest rates are headed higher. Obviously, if you have a bond portfolio, you have to take some duration risk, or and you actually have a portfolio at Bianco Advisors, and you have an ETF that tracks that index. Tell us about your weightings. I'm looking from a paper you have. So you're underweight duration, underweight interest rate risk, so shorter end of the curve. Not surprising. You're also underweight corporate credit, which is interesting to me. In a no landing scenario where nominal growth, everything goes up, wages, growth, spending, profits, everything goes up, and inflation goes up as well. That typically is a good environment for credit, right? Because enough cash flow is being generated to pay off debts. What you don't like is deflation, and that is definitely not what the scenario you envision. So why are you underweight corporate credit if your fundamental macro view of a no landing reflationary scenario tends to benefit credit?
Yeah, so just to put some square in it, we manage at BiancoAdvisors.com, we manage the Bianco Research Total Return Fixed Income Index, big fancy long name. It's an index. It's managed by committee, which I head. And so it's discretionally managed by us. So we decide on weightings like duration and corporate credits and structure, which would be mortgages, and whether or not we're bulleted or barbelled, and whether or not we have an out of index bet. And our partner Wisdom Tree has an ETF, WTBN, Whiskey Tango Bravo Nancy, WTBN, Wisdom Tree Bianco Fund is its name. It tracks our index. Think of the S&P Index Committee manages the S&P 500, and SPY tracks the S&P 500. So we're set up exactly under that structure as well. So within that index, which is discretionally managed by us, you were right. We are underweight we have a benchmark, which is very similar to the JP Morgan Broad Investment Grade or the Bloomberg US Aggregate Index. So a broad investment grade index. We are carrying a duration of less than what the duration would be of our index. So we're underweight. What does that mean?
So duration is exposure to interest rates. So if a duration of 5, meaning if interest rates go up by 1%, what you own goes down by 5%.
Yeah, that's the modified duration answer. It says is that yes, exactly. If your duration is 5 and interest rates go up 1%, all things being equal, you will lose 5%. If they go down 5%, you will gain 5%. And of course, that number constantly changes, and that's called convexity as well. So it's not a fixed number. And so we are underweight duration, meaning we are less sensitive to movements in interest rates. Why are we like that? Because we think interest rates are going to go up. And we don't, and to put it in stock market terms, it's like we're running a low beta and we're running a lower beta to interest rates. So we won't go down as much. We're offsetting that by having a position in the dollar through forward currency swaps, because the dollar index is highly correlated with interest rates in the United States. If interest rates in the United States go up, the dollar index should appreciate. And we're doing that through forward currency swaps so that we would gain if interest rates go down to try and protect ourselves from higher interest rates. So that's the first thing we've set up with our index, which the WTBN tracks, is that we're trying to position ourselves against a rise in interest rates. The second thing that we've done is we've looked at how to get a yield into our portfolio. We have 70% of our relative benchmark in corporates. So we're underweight corporates. You're right. In a no landing scenario, corporates should perform well, but their spreads, the yields they're offering are very, very tight, very rich. In other words, you're not getting compensated enough for corporates. But that doesn't mean that we've given away a higher yielding alternative. We're 120% the weighting in our index in mortgages. And, so the average mortgage is 5.5 or 6%. The average corporate is around the same yield. So given those two options, I would rather get my yield from a mortgage-backed security than from a corporate bond, at least right now, because corporates are so tight and I think mortgages are so cheap. And so we've positioned ourselves in to be announced TBA mortgages and some other types of mortgages as well in order to put our positioning well into that game. And then finally, we do out of index bets, and we have a 15% weighting in 0 to 5 year Treasury inflation protected securities, or TIPS. So if the perception is that inflation is going to be more than people think because we're stimulating the economy, those TIPS securities should do better than the average security. And that's why we've got that 15% weighting in it. Keep in mind that at the beginning of the year, the 10-year yield, just to give you one metric, we started the year at 3.88%. And as we're talking right now, it's about 4.12% or so. So interest rates are up for the year, and we've been bearish for, positioning more for interest rates rising than falling. There was a period in the year when we were kind of neutral on them as well. And so that's been helpful that our interest rate call has been more right than wrong. Now, from April to September, I'd been making the case of being bearish on bonds, but I'd also cleared out that we were very neutral in our portfolio, which we recently moved back to a more defensive position. But that's been turning around. The other thing that's been helping us lately has been that overweight in mortgages has been helping us lately as well. And then finally, that short-term TIPS position has been helping. So all of those have been helping. What's offset that was our dollar position worked for a while, didn't work. It's working again. It's kind of net against us, but now it's working again. Our corporate position it's been working for us to be underweight corporate, say, in the last month or two, but in the prior months before that, it did not work for us. But that's what portfolio management's about. It's about you doing several things at once. Some work, some don't. Hopefully, more work than don't.
Yeah. And so you say the reason that even though your reflationary no landing macro view is supportive of corporate credit, and that defaults will be mitigated because there's a lot of money going around. I'm noticing that, or you say that just it's too rich for you. The high yield bond spread I'm looking at right now, 2.99%. I did an interview with a large asset manager in the spring, and I remember at the time I did in my own histogram that going back to 1997, high yield spreads were 86% of the time wider, meaning it's a 14th percentile. They are quite rich, and now the spread is even lower. So it must be close to a 90th percentile rich, but you have to generate excess yield somehow. So it's interesting. You're taking it in the mortgage market, and how much is agency, which is guaranteed by the government, Fannie Mae, Freddie Mac, Ginnie Mae, versus non-agency mortgages? A lot of people listening, Jim, for good reason, will think of non-agency mortgage-backed securities as an enormous credit risk. However, it's important to note that the credit scenario right now is different. The mortgage delinquencies are exceptionally low.
Yeah. So in the first part of your question, you're right. I mean, when it comes to I want to get yield, it's all about alternatives, right? So if I look at the alternative of a corporate bond versus a mortgage-backed security, where do I want to get the yield? So it's not that I'm shying away from saying I want a product with yield. It's that I would prefer to get it in the mortgage market than in the corporate bond market because of the richness, as you pointed out, of corporate bonds, and the lack of richness. Because if you did a histogram like that for the mortgage market, it's not anywhere near those kind of tights. So I would rather take it there. As far as the types of mortgages we own, they're all agency mortgages. They're all backed by Freddie and Fannie. They're all backed by the implicit in backing by the United States government. It's not explicit, it's implicit, but that's the way that the mortgage market is understood. So what that means is that those mortgages present very little credit risk, if none at all. This is when somebody says, yeah, but Fannie and Freddie won't pay. Don't worry about it. Then your stock market's down 80%, because if the government can't pay, everything falls apart. But that's not the issue. The issue with more agency mortgages is they become interest rate plays. And if you look at those wide spreads of mortgages over treasuries, I think that those spreads are going to come in, which means mortgages will outperform treasuries on the downside and give us a yield at the same time. By the way, in terms of getting yields, those forward currency swaps that I mentioned too, they have over a 6% yield. So there's a big fat yield in making bets that the dollar will rise. So even when the dollar doesn't rise, you're getting paid a lot to hold those securities. And that's why we've done that as well too. So our average yield is higher, not by much, by a little bit, but still higher than the average yield in, say, the Bloomberg Aggregate or the JP Morgan Big, because of that mortgage bet and that forward dollar bet, even though we are shying away from the higher yielding corporate bonds.
That's really interesting. And I assume that being long the dollar, you make money because the dollar yields higher than the euro and the yen. So all you have to do is for the dollar to not depreciate against the yen, and that will make money because the dollar depreciation is priced in by the forward yields. That is interesting. Do you agree with Harley Bassman, another Monetary Matters guest, that new issue, that is to say mortgage-backed securities with a higher coupon, new issue mortgage-backed securities are a good place to be because you want to take greater convexity risk because interest rate volatility is slightly overpriced?
Yes. And let me point out one other thing about our fund. And this kind of gets in the weeds for people that might be interested in this. We only own other ETFs. And the reason we decided to go that route is there's over 500 fixed income ETFs. And whatever strategy we wanted to come up with, we could replicate that with an ETF. So when I said we own forward currency swaps, we own the ETF USDU, which only owns forward currency swaps, which has a 6% yield. And so we do look at each one of those ETFs that we have, behind what they own. It's far cheaper and far more efficient, especially in the bond market, to play with these ETFs. So now I said that, the reason I brought that up, 14% of our holdings is MTBA, Harley Bassman's mortgage fund. So we own newly issued mortgages for exactly the reasons that Harley had pointed out. And we own his fund for exactly those reasons. The last thing I'll point out about it, this is more of a kind of a macro thing for people. Our holdings are made up of about 15 ETFs. If you were to look through our holdings and you were to say, how many individual securities is that? That's over 2,800 individual securities. And we do track them not only as 15 ETFs, but what if it was just a portfolio of 2,800 securities? And we do structure it in that way, and we look at it in that way as well, too. It is, I can't emphasize what a game changer it is. There was a big, long piece in the FT about a month and a half ago called "The ETF is Eating the Bond Market." This is exactly why. Because if I was to manage a portfolio or an index with 2,800 securities, I'd need an army of 50 people to do this. But by using these ETFs, I could do it with a skeleton crew and pass those savings along to the index holders and to the ETF holders of our fund. And it's becoming the way that a lot of people are owning the bond market. So that's a long way to say, 14% of what we own is Harley Bassman's MTBA fund, which only has like 3 or 4 holdings, which are newly issued mortgage-backed securities. Good luck trying to buy those directly yourself. That's why the ETF is such a powerful tool.
And Jim, tell me about the TIPS, Treasury Inflation Protected Securities part. So there you are paid a yield and then you are paid inflation on top of it. There was a time where real yields were negative, meaning if inflation was 0, you would lose money. But inflation has been, you paid a positive rate. What has been happening with TIPS? And I guess, do TIPS make money or lose money as the inflation break even, basically market's pricing of inflation, go up or down, which I imagine they have been going down?
Right. So again, using the ETFs, we own STIP, STIP, and that is a TIP that owns TIP securities between 0 or, about to mature out to 5 years and no longer than 5 years. And now what is a TIP security? It pays you a real interest rate, which again is now positive, around 2%. And it pays you whatever the CPI rate is. So you will get that 2% plus 2.3 is what you would have gotten over the last year, because that's what the inflation rate is, on top of that 2%. they call that accretion. What they do is they give you more bonds. And in the phrase, again, is called accretion. So
So
if
it's
the
technically payment in kind,
yes, yeah,
but
to
of a
some
treasury security. So you're not the
right.
same. Yeah.
You get a yield, and then you own some bonds. You get a yield, and then as the inflation rate is positive, you just give you more bonds. Is you just wind up having more bonds. So now that I've said that, if the inflation rate is 2.3, and I think it's going to be settle back out into the 3 something, or between 3 and 4, and that residual seasonality is going to turn north, and help push the inflation rate back up. If I'm right on that, I'm going to get more bonds, and I'm going to get more bonds that I could get my 2% yield on. And so I'm going to get more bonds plus that 2% yield. When you start adding it up, now the yield on that thing is around 4.5 to 5%, or the return, excuse me, is around 4.5 to 5%. Thinking about that, is also, I'm only owning them out to 5 years. And the reason is I don't want duration risk. If I owned a 10-year tip or a 20-year tip, I could be completely correct on everything. But then if interest rates go up, those prices fall and more than offset those gains. That's why I want to own very short-term tips. And that's been a very good trade for us this year as well. So it's a play on the idea that inflation will start to trend a little bit higher, and that we're going to get more bonds that we get that interest rate on and give us a better return on our portfolio, or on our index, I should say, which then WTBN tracks.
And so as a tips holder, you want inflation to be high because you're paid inflation.
Right.
Do you want real yields to go down, which means you want nominal yields to go down, and or you want inflation break evens to go up, right?
Yeah. So as far as real yields, obviously, remember they're a bond, real yields. So when real yields go down, that means the price goes up, and that means that you get an appreciation in the price. Now you're right. Up until the big inflation spike in 2020, these same securities used to have a negative real yield. You used to have to pay to own them. That's what a negative yield is. You get paid to own them when there's a positive yield. You have to pay to own them if there's a negative yield. Well, that's not the case anymore. There is a real positive, there's a real yield that's positive. So you're getting paid to own these securities. And as inflation comes in, you get more bonds, that you're getting more securities that you're owned on. And that's where the return comes from. So that's why I like those types of securities at the very short end. Now, if the yield falls on them, initially, that's good because that means the price goes up. But if it falls so much that they go negative, then we start paying on owning them. But we're nowhere near that right now. But that would make me reassess my view on those if that were to happen. But right now, I still think that they've been an attractive play and will continue to be an attractive play under my scenario of that the economy's no landing, everything's okay, we're overstimulating with a fully employed economy, and that we're risking inflation. So there's my inflation play in short-term tips.
So, Jim, now I want to ask you about things that your index is not investing in. If you could say there are 2 core risks that bond investors take: duration risk, that interest rates go up, you lose money; credit risk, you don't get paid back. We've talked about some slightly more exotic risks: convexity risk with the mortgage-backed securities, maybe disinflation risk with tips, or deflation risk that inflation goes down. But I think it's fair to say, I know it's fair to say, over the past 2 years, credit risk has been the risk to take, and interest rate risk has not been the risk to take. And as a result, you have products that have lots of credit risk but very low interest rate risk, such as collateralized loan obligations, floating rate loans. The riskier, the better. Private credit. That's why we are in the so-called golden age of private credit. What do you make of this? Do you think this outperformance of credit risk over duration risk can continue? I mean, credit spreads can't go to zero, right? And do you think that there's maybe the golden age of private credit and of all of these alternatives are a little overrated? What do you think?
Well, yeah, so you're right. So the other risk you could take is a credit risk, and you could do it in many different forms. You can do it with investment grade bonds. You could do it with non-investment grade or high yield or junk bonds. You could do it with emerging market bonds. They have a big credit risk component built into them as well, too. You could do it with developed market corporate bonds as well. And there's ETFs to buy all of those if you think. We have only recently moved, like in the last 2 or 3 months, to our underweight in credit. We were more neutral-ish to slightly underweight. You're right. Over the last 2 years, credit has been a very good place to be. But given the tightness in credit today, I think they're too rich. And again, it's not like the stock market. I think the stock market is overvalued, so I won't own it. In the bond market, I think credit is rich, but I have alternatives in mortgages, in tips, and in the dollar that I can own a big yield in other ways. So it's always a competition of other alternatives. So I'm thinking that the credit market was a good place to be, but currently, right now, given its richness, I don't think it is. I think that there's better opportunities to get a yield. Remember, why do you want to own credit? You want to own credit because it throws off a higher yield than a treasury. Well, there are other things that throw off higher yields than a treasury too, that are comparable yields to credit, especially how tight credit spreads are. Credit spread would be how much more you get above a treasury in a credit instrument. And I would rather want to own those other types of instruments, like a mortgage or a dollar forward swap, or a short-term tip. I think those are better places to be. We're not against credit. There's going to be environments, I think, in the future where we'll probably be very heavily invested in credit. It's just that currently where credit is right now, I just don't. I think there's better alternatives to it.
So you talked about high yield bonds and investment grade bonds, vanilla kind of old school. What about private credit, which are mostly floating rate loans to a lot of non-investment grade companies? And basically, a lot of the risky activity and deal making that used to be done in the high yield bond market is now done in leveraged loans, but also private credit. As you know, Jim, that the growth in that market is enormous. I guess I'm asking you to give me a headline, either the golden age of private credit is golden, it will stay golden, or the bloom is off the rose, things are overrated, I have some concerns. Which camp are you in?
Well, I'm kind of in the middle, and I don't mean to be dodging your question. And let me just say, for starters, there's about 5 or 6 private credit ETFs that have been filed. They've not started trading yet. So in the next few months, we're going to get a whole slew of those, which works well for the types of things that we're thinking about as well. Private credit, let's just talk about where private credit is and why it's become so popular. Following the financial crisis, in the banking problems that we had in the financial crisis, we passed Dodd-Frank, and we passed a lot of other rules, Basel III, which is the capital rules for banks, the international capital rules for banks. And let me bottom line it for you. We have made handing out a loan very difficult for a bank to do. So they haven't been handing out loans. Filling that void now has become non-bank entities that hand out loans in the form of private credit. This is why Jamie Dimon loses his mind over private credit. I've got JP Morgan, and I would love to hand out those loans, and this is a true story, JP Morgan every day makes space for hundreds of regulators from the FDIC, the Fed, the OCC, the SEC that do nothing but sit in a JP Morgan office 40 hours a week, regulating JP Morgan, hundreds of them. They are so hamstrung by all of the rules, they can't hand out as much credit as they would like to. So here comes Apollo, and here comes Blackstone, and a lot of the other firms that are not regulated like that. They don't have to make space for hundreds of regulators to look over every single piece of their business and pass judgment on it. And they're filling that void. And Dimon's losing his mind because he's losing out to these private credit, like unregulated banks, in order, that he can't get into that business. He would like to. So that's essentially where private credit is filling that void. We overregulated the banks. There's a need for credit loans, and it's being filled by non-banks. Now, a lot of those banks have really non-banks have really ramped up quite a bit, whether you're talking about some of the newer players like Blue Owl
Yep.
and the like that have really flooded into this system. It is an interesting place to play. For most people right now, it is a very difficult place if you're in the public sector like we are, it's hard to play. You'd have to have a direct investment with Blackstone or Blue Owl or Apollo in order to participate in these private credit funds. But they're coming, and they're coming fairly soon. I think, if nothing else, the way I look at private credit is, and that private credit, by the way, is going towards the lower end. This is not, we're going to be Apollo and we're going to hand out a loan to Amazon, or we're going to hand out a loan to Walmart or some other trillion-dollar company. We're handing out loans to smaller end businesses is where we're giving those loans to. And these smaller end businesses it's also helping to propel the economy. And it's also helping us, especially when it comes to the Federal Reserve, looking at things like credit growth as a proxy for GDP growth, being a little bit misleading because these private credit numbers are not being captured in that credit growth area. So it has been an area which I think is growing quite a bit. It has had an impact on the economy, especially at the lower end. And coming very soon will be instruments like some of these private credit ETFs, like in the period of a couple of months, that, the investors that are listening to us on these calls don't have to call up Apollo and invest in one of their private credit funds, or Blackstone and invest in one of their private credit funds. There'll be other avenues for us to get into it. And we'll be looking at those very hard too when they become available.
And Jim, I was at a conference 6 months ago. I first heard the concept of a private credit ETF. To me, it was some far-flung idea that, to me sounded a little nonsensical, to be honest. And it's amazing how quickly things are happening. That they've already been filed and they may come out. Isn't it a little nonsensical, I won't say ridiculous, to have a publicly traded thing such as an exchange-traded fund to own something that is so illiquid? We already saw with a high yield ETFs in March 2020. The ETF is much more liquid than the underlying bonds, as you just said. So the avenue of price discovery is the ETF, and that's why the ETF sold off way more than the underlying bonds. So you had a very wide spread. I mean, I can't even, and I think of CLOs and that kind of stuff even worse when there's a liquidity crisis, which we haven't had in over 4 years. I can't even imagine what it is like for these private credit loans where you make a loan to a $50 million company, a very small company, and no one else owns the loan except one sponsor, or a club deal, 3 sponsors. And I guess now all the ETF holders own it. But I guess in what way would this be different than, I'm not going to name tickers, but business development companies that own risky loans, or companies that own senior loans that are floating rate? In what way would a private credit ETF be different than that? And if it is different, in what way would that in any way be a good thing?
So to bring up to the first part of your question, yes, I'll harken back to the Robin Wigglesworth story in the FT about 2 months ago. The ETF is eating the bond market. I cannot emphasize enough that the biggest thing that's happening to the bond market is the ETF. The ETF is changing the very nature of the way bonds are traded. And you're right, we saw this during the 2020 crisis, that the ETFs become the pricing mechanism for illiquid things like high yield bonds, maybe for credit. You said, bear in mind, we don't yet have an ETF for private credit, but coming to this space very soon. There will be one. And yeah, these will be the primary pricing mechanisms for this. We do have CLO ETFs, and they are also considered to be the way that this is the thing that we use to price these things. And yes, you are correct. And yes, we are aware that when things get ugly, these ETFs become the only source of liquidity. And there's an old saying in the market, when things get ugly, you sell what you can, not what you should. And people sell the ETFs because they can. They should be selling the underlying bonds, but they can't. And so that they tend to exaggerate the move. And yeah, we're very aware of that. So whenever we see ugliness coming, we will be cautious of owning these ETFs that have very illiquid underlying securities that back them. So currently we don't own any of those now, but we're not against that in the future if circumstances dictate it. And so, yeah, that is going to be a very important thing to keep in mind. But you're right, you are taking on greater risk with these companies because normally what happens with a bank is a bank hands out a loan, and then the bank sells the loan to a whole bunch of people, and it gets split up into a CDO or a CBO or other investors
CLO, yeah.
buy CLO or other investor, whatever CL we're talking about. Other investors buy these, and you share in the profits and you subsidize accordingly all the losses. That's what we do with mortgages as well. But in this case, you want to own the whole loan, or maybe only split it with one or two people because you think that loan is good. Now, part of what could be happening too is that these private credit funds might have a bit of a hand, at least in advising the companies. I mean, I don't want to say outright helping them pay the loan, that they wouldn't do that, but advising the companies or have a very close feel for that loan, and that would feel very good that handing this company this loan to do what they plan on doing with the money is going to result in them paying us back our interest and our principal before the end of the loan. And so that's been working out very well for them, but we're in early stages. Now, as the industry matures, it's going to look a lot more like banks, is what it's going to look like. It's going to look a lot more like bank loans. It can't not look like bank loans. But what they hope in that industry is they don't wind up being regulated like a bank, and that they have to make space for 100 regulators to sit in their office and pass judgment on every single thing that they do, like they have to at JP Morgan or Citi or Bank of America. But, that's why we're in the early stages of it. It's been a very successful business, being the private credit business.
And I mean, if private credit grows as it has continued to grow, that will be very good for those companies, that they'll be making a lot of money. Do you have any view on, like, I guess you can, there are publicly traded stocks that do that. Do you have any view on those companies? You've said, Jim, that you actually have been underweight financials. You don't think banks are a good investment. Do you think that these alternative asset managers are a better investment than banks? Just as bad? Worse? What do you think?
No, I think that the alternative, in general, these alternative managers are a better investment than the banks. One of the other problems that the banks have is, beyond the big four banks, Bank of America, Citi, Wells Fargo, and JP Morgan Chase, which have about 80% of the banking assets in the United States, those four. The other regional banks and the smaller banks, community banks, which number about 4,000, have the other 20%. They are the vast, vast majority of commercial real estate loans. Commercial real estate is in a world of hurt, especially because of office. And these banks are really suffering under it. Private credit, by the way, never got a chance to get into the commercial real estate business in a big way. So they kind of dodged that bullet. So the banks are sitting there handing out loans to people building office towers that no one wants to go to, where private credit is handing out loans to people that want to build businesses and paying them back. So they've definitely got that benefit going for them, maybe because of the calendar. If they had invented private credit 10 years earlier, they probably would have plowed headlong into handing out office tower loans and then be stuck with office towers that no one wants to occupy. But they didn't. Maybe they were smart, or maybe they were just lucky with the timing, or a little bit of both. But all things being equal, I do like the alternative managers better than the banks. The reason I don't like the banks is they're highly regulated, they're very constricted, and they have a bunch of bad commercial real estate, which I thought for a long time wasn't being appreciated by people that want to keep buying banks. Now, the banks have really underperformed badly over the last couple of years. And I think that the banks I'm not as negative on the banks, just because they've been such a bad performer, and that their valuations are coming more in line with where I think they should be. But I'm still not warming up to them. And by the way, there are fixed income ETFs we could buy if we ever thought that, like, financials were a good place to be, or something like that. There's an ETF for everything.
But would have to be a preferred shares or debt of banks. You can't buy bank equity, right?
Right. And there are both. There are preferred share ETFs, and there are ETFs that buy financial debt. The debt of financial companies. We just don't own any of them right now. But I'm just pointing out the breadth of the ETF market is really astounding. Even when I started looking into it, and I think I know something about this, I was still surprised. And boy, it's really hard for me to come up with a strategy that I can't replicate with an ETF. And it's so much cheaper and easier to do it with an ETF than doing it in the underlying market.
I think a lot of the reason the banks have underperformed is just because of I would say duration risk rather than credit risk. And commercial. So a lot of the large, as you say, the large banks, a percentage of their assets are not in commercial real estate. Wells Fargo has a lot of CRE exposure, but are in the regional banks. Of course, the insurance industry, which is thought of as a risk-free industry, they have a lot of commercial real estate loans that is not often enough talked about. I would say, Jim, that in the same way that interest rates are short-term interest rates are going down, but they're not going down as much as has been priced in. Commercial real estate, the pain has been there, but it wasn't as bad as a lot of people were saying on Bloomberg, on CNBC, and on my show. And by the way, many of them were working in the industry. They didn't write, the CRE Doom newsletter. It's coming from. I interviewed a large real estate developer who compared the state of, office space to the Titanic. But you look at and admittedly it's A tier, A list properties, but as interest rates have fallen, these real estate investment trusts are going up.
Yeah. So a couple of things. You're right. What happened after Dodd-Frank, that was the big bank regulation rules in the wake of the financial crisis in 2010, was we said to the banking industry, credit is bad. Handing it credit risk is bad. You have to rein in and really restrict the credit risk. Well, that meant two things. One, you couldn't hand out a loan, which is what we talked about, private credit, taking into that, filling in that void. Two, well, if I'm a bank, where am I going to make my money? If I can't make my money by handing out loans to companies and hoping they pay me back, I'll make my money by taking duration risk, by betting on interest rates. I have to do something with this money to make a profit. And that worked out well until 2022 when we had the big rise in rates, and that culminated in the spring of 2023 when Silicon Valley Bank failed because of its bad duration risk as well. So yeah, that's largely been what's been driving it. As far as commercial real estate, I guess I'm dating myself a little bit because I'm maybe giving you more of a circa 2023, early 2024 argument about real estate. I was of the opinion, even in 2022, because of the nature of work changing and remote work, I'm like, I think that these office towers are the Titanic. And I think that these office towers are going to go down. But I kept hearing everybody say, no, everybody's coming back to the office. Don't worry, we're going to reopen. We're all going to get mandates to go back to the office, and we're all going to go back to the office, and the office towers will be fine. Well, that kind of has disappeared by the second half of 23 and into 24. No, we're not going back to the office. And no, a lot of these offices are in trouble. And yes, in New York City, in Manhattan, you might look in Midtown and go, there's a lot of Class A, which is the highest quality office towers that are fully staffed or close to fully staffed. But the majority of the stuff is B and C, and it isn't. And these are empty buildings or near empty buildings. And what's going to happen to them? And then the other problem is, even with the Class A offices, as people go back to the office or don't go back to the office, let me throw in another political thing for you too. When we passed the CARES Act, we had the federal government subsidize mass transit in the United States for 5 years through the end of next year. Well, in 24 days, we're going to have an election. If we have any kind of divided government, a R behind anything, the president, the House, the Senate, all of it, some combination of it, there's probably not going to be an extension of mass transit subsidizations through the CARES Act. In other words, the New York City subway system is losing unbelievable sums of money, but the federal government's writing them a check so they keep running trains on Monday and Friday that no one uses. Well, eventually, when those checks run out, in 24 days, if there's a Republican and a Republican say, we're not going to subsidize mass transit in blue cities like New York City, and then eventually they're going to have to start changing their service. And that means they're going to run Sunday service on Monday and Friday. Then even those Class A offices are going to have a problem. Yeah, I want everybody back 5 days a week, but they can't get here. There's no train for them to get here on Monday and Friday, or it's much longer commute for them to get here on Monday or Friday. And and then they're going to scream, no, you have to keep this service going on Monday and Friday to get everybody back in the office. Well, we're losing tons of money on it. You got to pay more taxes in order for us to run this service. And this is the vicious cycle we're going to be caught in as we go forward. And that's another outcome that no one's thinking about the election in 24 days. If there's something, look, Republicans know that the blue states don't vote for them, and the blue states are, and the blue cities, excuse me, don't vote for them, and that's where most public transportation is. And the blue cities are being subsidized to continue these services that are losing money, and that might end at the end of next year in 14 months if you have Republican something after the election in 24 days.
Right. Yeah, Jim, I'm not saying that you're wrong on the fundamentals of going back to work. I mean, the numbers are what they are. I just looked it up. The office building occupancy rate is 62% of what it was in 2019. I just think that so much bearishness was priced into the publicly traded names. I'm looking at a office real estate investment trust, or mainly in New York, and it was down price, not including total return, not including dividends. It was down 80% from 2019. So from the low, it's up 160%. It's still not close to its 2019 level. Jim, final thing on the election. I don't like talking about it too much. Which
who's going to win?
Donald Trump? No, that's a possible question. Who do you think will be better or worse for the bond market and inflation, and why?
Oh, I'm going to answer the question neither or both, depending on which way you want to look at it. And I'll give you a reason why I'm going to say neither or both. Notice, Jack, you push back on this if you want. I don't hear a lot of people talking about the Trump trade is this, the Harris trade is that. Oh, yeah, the Trump trade is to own Tesla and some prison stocks, but that's not like an asset class type of thing. And the reason that there is no real identifiable Trump or Harris trade is they're both kind of going to have the same impact for the bond market and for the stock market. If Harris wins, there's going to be more spending and a big deficit. If Trump wins, there's going to be big tax cuts and a big deficit. So your choice is between a big deficit and a big deficit. Now, there's other non-economic reasons you want to vote for them, and they do differ a lot in social policy, foreign policy, other, like I said, non-economic things that might drive your reason to vote for them. But as far as the economy goes, I don't think necessarily that they matter. Now, I know that there's a spin out there that, well, Trump's going to be bad for the bond market because he's going to slap all these tariffs on everything, and these tariffs are going to create inflation. I will point out that's true. That's what he says. There's no reason to believe he won't do that. But I'll point out that in the toxic partisan environment of Washington, there's really one thing economically they agree on. All of Trump's tariffs that he put in 2018 and 19 largely still exist. So both parties are basically pro-tariff. It's just one says it out loud and the other one doesn't. And so I think we're just overstating the case that Trump's going to create inflation with all of his tariffs. We'll see. I mean, he has every intention. His intention, and I don't mean to advocate for Trump, his intention is to use tariffs as a hammer to get concessions from either the Chinese or the Mexicans, or whoever he wants to put them on. And if he winds up getting those concessions, those tariffs will never come to pass in the first place. So we'll see what happens with it. But I think we overstate that Trump is inflationary because of tariffs, but the Democrats don't say anything about tariffs, but they have them too. As well. They didn't get rid of any of Trump's tariffs from 2018 and 2019.
Thank you, Jim. My final question for you is about consumer credit. Earlier, we talked about how credit was performing well. We were talking about the implied default rate on corporate credit, bonds, private credit, and the like, just how much is being priced in. They've rallied a lot. But in terms of realized defaults on consumer credit, auto loans, and credit cards, delinquencies are up massively. The great Liz on Saunders, I was just on Twitter, she's posted about how the auto rate delinquency rate is where it was in 2010. I see the credit card delinquency rate is where it was in 2011. So a lot of consumer loans, like the two biggest parts other than mortgage, which is, delinquencies are very low there, are higher than they've been in 13 to 14 years. Does that give you any pause or concern about where this economy is headed?
It does give me a lot of pause and concern, and I'll tell you why. 70% of consumer spending, 70, is the upper half of income. 85% of consumer spending is the upper 70% of income. A lot of that consumer loan, when you break it down, who is defaulting on their auto loans, who's defaulting on their credit card debt, tends to be the lower half of the country, the lower income half of the country, especially the bottom 30%. Why is it that they're defaulting on it? they've the inflation. We really underestimate what inflation has done to the bottom half of the country. We in the top half of the country see inflation go up. We mutter some unmentionable words about how much more prices have gotten. But then we look at the Zillow and it says our house price went up. I look at my stock portfolio, it's at an all-time high. And I just pay it and move on with my life. Bottom half of the country, they look at prices and go, okay, if I have to buy this, I can't buy something else. And they have to make some really hard choices and they load it up on their credit cards and then they don't pay their credit card debt. And so it really is the manifestation of the K-shaped economy, that the top half is doing well and the bottom half is not doing as well. Does it concern me? Concerns me a great deal. It is showing up in the unhappiness about the electorate. It's showing up in how inflation is the number one issue that we're voting on when economists say, but inflation's down and it's been solved, but the public is still seethingly mad about it because the bottom half of the country still has one vote, just like the top half of the country has one vote. So that matters quite a bit. Now that I've said that, it is the top half of the country that drives consumption and drives retail sales and is driving the economy forward. And they're not defaulting and they're continuing to spend. And we're continuing to see it. By the way, there's a great chart. In fact, I might have retweeted it, put out by Michael Hartnick at Bank of America, the manifestation of the K-shaped economy. And it's the stock price of Ferrari, which is going straight up, and Dollar General, which is going straight down, to basically describe the type of economy that we're in. And what you're seeing with the Dollar Generals going down in the default rate is it's the bottom half of the country that's defaulting. And we have to be real about it. That's not where the spending is. The spending is closer to the Ferrari class and or maybe the BMW class. Maybe they're not quite all the way up to Ferraris. And they're continuing to spend. And that's why the GDP numbers in the economy continues to go. And that's why the risk of even more inflation is real. And that's why inflation matters. The bottom half, that Dollar General class, will just get whacked even worse if we have any kind of surge of inflation.
And I believe, Jay Powell, I agree with you that inflation hits hardest the people who are least able to bear it, and specifically oil, gasoline, things that you need to go to work, you need to drive places, and it's not discretionary at all. That is a much higher percentage of the consumer basket of lower income consumers. But Jim, since 2022, when the price of oil was $120, I mean, hasn't the remarkable disinflation we've had, alongside the softening of the labor market, but it could have been so much worse. Like, how much better could it have gotten?
Yeah, no, I know exactly what you're saying. But on to the first half of your question, yeah, that's why if you remember Powell's famous speech in August of 22 at Jackson Hole, the 8-minute "There Will Be Pain" speech, is basically what. Let me tell you what the speech was. Hey, you people listening to us, and you own a stock portfolio and you have your house. Do your patriotic duty and hope that your stock portfolio goes down and Zillow says your house is worth less. Because if that happens, that will cool demand, bring down inflation, and help the Dollar Tree general class get by with lower inflation. Well, we've had enough of that. It's time for a stock market rally. It's time for Zillow to tell me that my house went up as well. And that's why we're kind of seeing the flip side of that. So I think that when you look at the economy, yeah, it is a difficult thing to kind of get your head around on where the economy is going, because my circumstances, your circumstance, is not the circumstance of a lot of people. It is K-shaped, and that's what we might be seeing in the K. And when we see the delinquencies, again, I'll point it out, the delinquencies are high. But unfortunately, they're among the people that weren't spending money anyway, that were driving the economy. The people that are spending money that are driving the economy are not seeing those delinquencies.
And Jim, how much of the upper upper quintile spending money is because they actually are doing well other than assets, or it's just because assets have gone up so much, so it's the wealth effect? And in other words, you could say it's all built on a bubble if you wanted to be cynical about it.
Well, yes, it's a couple of things. I mean, if you look at college educated, the unemployment rate, it's still in the 3 handle. It's still 97% of people that have a college degree have a job, that want a job. And if you have a job, as I said, you get money every week to spend. And then if you're in that category, you own a home, you own some assets, and they're appreciating in value too, and they make you feel a little bit more comfortable. And that's one of the reasons why the savings rate might be falling. The savings rate averaged 6%, pre-pandemic. It's been averaging around 4% post-pandemic. That's a big difference. And why is it averaging? I don't have to save as much of my income anymore. I could spend more of my income because Zillow and my brokerage account are telling me that that's my savings, and that's what's increasing my savings. So I do think that there is some of that. Look, I'll come back to what we were just talking about. There's a reason Ferrari is going up and is at an all-time high. And it isn't because they're making affordable cars. It's because there's people that can afford a $150,000 to $200,000 car, and they're willing to spend money on a $150,000 to $200,000 car. And the reason is they've got a job and they're generating income, and they've probably got assets that have made them enough money that they're willing to convert some of that into a new Ferrari.
Jim, thanks so much for coming on. People can find you on Twitter at Bianco Research. A pleasure to speak with you. Thank you, everyone, for watching. Remember to check out Monetary Matters, not just on YouTube, but also Apple Podcasts, Spotify, and wherever you find your podcasts. And please leave a rating and review on Apple Podcasts or Spotify. It really helps the show, and it just makes me feel good. So thanks again, and talk soon.
Thank you. Just close the door.